The markets in the month of May have been oblivious to all that, right? They're not paying attention to any of the stuff that's really going on. Nobody sold in May and went away, unless you're talking about people who own gold stocks. But May was a huge month for the stock market, particularly the NASDAQ. I want to go over that. So the month of May, which ended today, this was the last day of the month, and the NASDAQ was up 6% in May, 6%. And if you look at the NASDAQ 100, right, the QQQ is the ETF for the NASDAQ 100, the biggest NASDAQ stocks, that was up 8% in the month. That's it. I mean, it's a huge number, led by NVIDIA, right? NVIDIA was the biggest gainer. It was up 36.5%. And that was with like a 5% decline. I think it was down today by that much. I'm going to take a quick look at it. 5.6% on the day. But even with that decline, you still had like 36.5% increase on the month. And you had other stocks, Google, Meta, a lot of these big stocks that are perceived to be the main beneficiaries, the initial beneficiaries of the AI revolution. Those stocks saw the biggest inflows and the biggest gains during the month of May. Now, if you take those stocks out of the game, there really wasn't much going on. In fact, the S&P 500 was only up about 1/3% during the month. All of those gains attributed to the big tech stocks that are part of the S&P 500. If you look at the Russell 2000, which doesn't have all these tech stocks, it was down 1%. The Dow was down 3.5%. That's a pretty big decline in 1 month, especially when you consider the 8% gain in the NASDAQ 100. In fact, the divergence between the NASDAQ and the Dow has not been this big since the bubble, the dot-com bubble of the late 1990s. That's where you have to go to find this kind of divergence. So the tech stock buyers have been oblivious to all of the problems underlying the economy and the rising interest rates, rising inflation. All they're thinking about is this AI revolution, which may in fact have some very positive effects on productivity in the long run, but they're not going to be that immediate. And a lot of people are focusing on the so-called deflationary effects of AI, and that it helps to bring down costs because it increases productivity, and so companies can now produce more goods for lower costs. And all that is true. And that's not deflation, that's just capitalism. That's how capitalism works. It lowers prices. Government raises prices by creating inflation. Now, normally what happens is the government creates more inflation than capitalism creates productivity. And of course, capitalism creates less productivity when you burden it with more government. But what has been happening for the 20th century and now the 21st century is inflation has been the stronger factor than rising productivity. And so we lose the productivity gains and we end up with rising prices. Now, prices would rise even more if we didn't have the increasing productivity. But if we didn't have the inflation, prices would have dropped, and that would have been great. But the reason I think that AI, at least in short run, is going to actually result in more inflation, despite increasing productivity, is when companies lay off workers, because that's where the increased productivity comes from. Because you're eliminating workers and you're replacing them with AI, right? So you don't need as many people. It's not just so each employee, can have more AI. It's to eliminate the employee and to use the AI instead of the employee. That's where you get the significant cost savings, which lead to the greater productivity. But the problem is when people get laid off, the government loses a lot of revenue because all those workers were paying taxes. And the companies were paying taxes on those workers too. There's a big payroll tax in addition to the income tax. And so when these people lose their jobs, the government loses a lot of tax revenue. In addition to that, now the government's got to spend money on unemployment, on food stamps, on all this stuff. So AI in the short run is going to explode the budget deficits of the United States. That's going to lead to even more money printing. And so, yes, businesses will be more productive, but the government's going to produce a whole hell of a lot more money. And I think in the short run, the money printing is going to trump the increased productivity. And so prices are going to go up because the dollar is collapsing. Now, in terms of gold, yes, you're going to see prices coming down. And AI will accelerate the degree to which prices fall in terms of real money, gold, but is going to end up increasing the rate at which they go up in terms of fake money, fiat money, like dollars. Now, actually turning to gold will be, but in contrast, the Grayscale Bitcoin Trust, which normally has a very strong correlation with the ARK ETF innovation, it fell 5.5% on the month. That's a big drop, especially when you compare it to what was going on with tech stocks. So Bitcoin seems to have decoupled from the tech story, right? It's going down, not up. Now, some people think, well, no, it's now correlated with gold. Not really. I mean, gold was only down 1.3% on the month. You know, that's not a big drop. I mean, there was a big drop in gold mining stocks, but not in the metal itself. The GDX, the senior gold miners, was down 8% on the month. The opposite of what happened to the NASDAQ 100. NASDAQ 100 up 8%. Big gold stocks down 8%. The small ones, the juniors, were down a little less, actually. They were down 6.5%. But this shouldn't be happening. Right? The environment that we're in right now is very bullish for gold stocks, and it's actually bearish for tech stocks. It doesn't matter right now about the AI. The rising interest rates and the inflation are a bigger factor than AI. And of course, the main beneficiaries of AI have got to be the overall economy, not just these tech stocks. Right? It's got to be basic industries who are implementing the AI in order to increase their productivity. It's not just some of these tech companies that are selling the stuff. It's got to be beneficial to all the other companies who are buying this stuff. But none of that is in the numbers right now. But it hasn't reasserted itself as digital gold. And I think the next thing that you're going to see is a rise in the price of gold. And I think this debt ceiling increase can be the catalyst to get the move of gold above 2,000 where it can stay. I mean, right now, as I speak, the price of gold is below 2,000. It's $1,964 an ounce. But, compared to where we started the year, gold is still nicely higher, but it should be a lot higher, and it will be. In fact, there are a lot of people who were worried that the failure to raise the debt ceiling would be a problem because it would cause a flight to the dollar, because people would be looking for safe havens and everything was going to go down. I always thought the opposite. I always thought that the problem, or the good thing for gold, would be, or rather, they thought that if there was a default on the debt ceiling, that would be good for gold, right? That people would run to gold because, treasuries are in trouble, the government was defaulting, that people needed gold because they worried about a default. I've always thought it was the opposite. The reason you want gold is because we're not going to default. We're going to print instead. We're going to raise the debt ceiling. We're going to keep creating deficits. We're going to keep creating inflation. And that is what is bullish for gold. And that's why the price of gold, I think, is headed a lot higher as a result of this increase in the debt ceiling.